Hi, and welcome to Investing Channel TV. Now, oil prices have joined bond yields in doing the unthinkable, trading at negative levels. WTI May futures prices closed at minus $37.63 on Monday, the first time the oil had ever gone negative. The NYMEX West Texas Intermediate is a physically settled oil futures contract, meaning that anyone long a WTI contract upon expiry must stand ready to take delivery of the crude, and anyone short must stand ready to deliver it. Now, those traders not intending to take or deliver physical oil often begin the process of reducing their exposure several days before the contract expires, so not to be caught offside. And these are known as paper traders. In general, a trader can either close a position outright by purchasing an offsetting contract or roll their exposure by purchasing the offsetting position in the expiring contract and establishing a new position in next month's contract. It's generally accepted that a supply glut amid the coronavirus pandemic created demand and sending prices lower. And the move was amplified by the expiry of the current contract on Tuesday, with traders selling soon-to-be outdated futures and buying up those with a longer shelf life. However, in recent years, the number of paper traders has come to far outweigh those physically trading in the tangible product. And in the event a paper trader is left with a position into entry, they must turn to a physical trader to take on their position. So when the May 2020 WTI contract expired, two separate issues kind of combined to make the normal expiry process impossible. First, the amount of paper positions left open into expiry was exponentially larger than in the very recent past. That's over 100,000 contracts open compared to just 45 2 months ago. Now, the reason for this remains unclear. However, some have pointed to the USO ETF, which has seen large inflows in recent weeks, requiring large purchases of WTI contracts. And at the same time, physical crude storage is nearly full due to the severe demand impacts of the corona crisis. Physical traders found themselves with little to no spare capacity, leaving them unable to purchase the remaining open futures contract. And the result was basically a short squeeze in reverse. Traders were forced to repeatedly reduce their offer price to try and find an able buyer. However, when no such buyer presented themselves, the price broke through zero, with trap longs offering to pay the buyers up to $37 per barrel to take the crude off their hands. Now, that's the conventional kind of understanding of what's happened. But in recent days, another factor has come into the consideration. And that is reports that investors are mulling class action lawsuits against the Bank of China over its crude oil futures trading product. Now, the Bank of China's crude oil futures trading product is known as crude oil BAO, and it's linked to crude oil futures contracts. And according to reports, the Bank of China rolled over its WTI May futures contract just 1 day before settlement and recorded huge losses due to liquidity problems. Investors have argued that the Bank of China's risk disclosure was insufficient and that the bank didn't adhere to its own rules on risk control. For comparison, other Chinese financial institutions like ICBC and CCB rolled over their crude oil contracts on April the 14th and 15th. Now, the Chinese media are reporting that the Chinese regulatory authority has asked major banks to conduct self-inspections on crude oil-linked products, and due to the high volatility of oil prices, some banks have even stopped recommending these products whatsoever. Furthermore, there are reports that the Bank of China has contacted the CME and market participants and confirmed the settlement price of minus $37.63 per barrel. And in total, if that's accurate, it looks like the bank took a $5 billion hit. So, with all that digested, the question is, where do we go from here? In reality, despite all the dramatic headlines, this looks to have been more of a technical issue, not systemic. And as the corona shutdown eases and demand returns, alongside OPEC and North American cuts phased in, we might see prices slowly trend towards 30 as Q3 unfolds. However, it's worth remembering that oil prices have only been comprehensively recorded for about 150 years, and the long running average is around $47, whereabouts both Brent and WTI were trading at the start of March. So that's all we have time for, folks. Safe trading.